Privileged to be filming here today at 40 Bells Boulevard, Jan Jac, moments from world-famous Bells Beach, for sale with Carl Hammond. Surrounded by nature, this unique retreat-like family home provides a tranquil lifestyle for everyone to enjoy. Joining me today, I have the Director and Financial Planner, Jamie McIntyre from Mac Financial. Today we'll be discussing strategies for property investors from first-time investors through to retirees with property. Welcome, Jamie.
Thanks, Donna. I'm really looking forward to today.
What are the key factors young investors in their 20s and 30s should consider when deciding to enter the property market?
I think what's important for all investors when they're entering the property market, and specifically those in their 20s and 30s, is they need to demonstrate to themselves that they can save money so they know that they are in a position to invest in something and also take on debt to buy a property.
How should young investors balance between leveraging debt for property investment and managing risk?
Well, young investors taking on debt for the first time is a significant thing, and I think it's really important that they manage their risks by always having a sum of money tucked away in the bank, and let's call that an emergency fund. And with property, what we know is they're not rented out all the time, so you need some money up your sleeve for the rainy day where there's no rent coming in.
Absolutely. I think one of the most important things for first-time property investors is regarding building credit and favourable mortgage terms. What advice could you give them, Jamie?
Donna, I think it's really important that you demonstrate to yourself first that you can save money, because fundamentally that's what the bank wants to see. They want to see that you're a good person to lend money to, you're going to be in good shape to be able to pay your loan when you take that loan. So securing a good credit score is demonstrating to yourself first that you can save and not overspend.
So, Jamie, how important is diversification for young property investors, and should they consider other asset classes alongside real estate?
I think young investors should always consider other asset classes, but today we're here to talk about property and buying your first property. And all young investors should have some superannuation where they have money invested in shares and other things, and they can take an interest in that as part of their diversification.
Thank you for those helpful insights for our first-time investors. Now, Jamie, let's talk about young families or those in their 30s and 40s. What strategies should these property investors focus on to scale their portfolio while managing increasing life expenses?
Yeah, Donna, those in their 30s and 40s with young families, generally there's a change in dynamics to their incomes. Maybe there's only one person working at that point in time and one at home looking after the family. So it's really important that they keep a really good eye on their expenses and reduce a lot of their discretionary spending so they're in a position to potentially either invest more or pay down more of their home loan debt.
Jamie, how can investors in their 30s and 40s take advantage of market trends such as interest rates and housing demand whilst mitigating potential risk?
I think right now, Donna, with interest rates being high for where we are in the cycle, there is actually opportunities for investors to be buying properties at this stage. There is not as much demand as normal, and prices are holding fairly steady, which provides opportunities to buy into an investment at a pretty good price.
Is it more advisable for property investors in this age group to focus on rental income, property flipping, or long-term appreciation?
I think, Donna, for this group, property flipping is difficult because they're usually quite busy with their family. They don't have time to put into the property, and most people make money out of property flipping by the time they put into the property, such as doing the carpentry work, the plastering, and all that sort of thing. So property flipping is probably not ideal. When we talk about income, if you're seeking a higher income on your rental property, you're generally trading off long-term growth. So the view I would have is invest for long-term growth in property always and look for the long-term return, which we know historically has been delivered.
How should investors in their 30s and 40s approach refinancing, leveraging equity, or selling underperforming properties?
Refinancing is definitely a little bit more difficult in their 30s and 40s due to that reduction in income whilst maybe one spouse is at home looking after the family. But that shouldn't stop you from speaking to your broker and reaching out and having the conversation to see if you can get the best deal possible. When it comes to underperforming properties, if you've made a mistake and you've bought a property that's unlikely to perform in the future, don't anchor yourself to it, don't hold on to it, have the right conversations with the right people such as the real estate agents, your financial planner, and make a good decision for your future. Don't get stuck with something that's not going to perform for you.
What changes should property investors in their 50s and 60s be thinking about?
Well, when you're in your 50s and 60s, you now have an eye on retirement and things are starting to change. One of the most important things is to pay down your debt, preferably to zero, but to a nice reduced amount ready for you to retire. Another consideration is to sell down a property in this phase to get you some liquidity. You're going to need some of that liquidity to support your retirement income needs.
Jamie, can you please expand on what you mean by liquidity for retiring investors?
Donna, it's really important, not just for retiring investors, but for everyone to have some liquidity. And what do we mean by that? That's having some cash in the bank at all times, or something you can turn into cash pretty quickly. So as investors move into retirement, usually they'll sell down one of their investment properties to make sure that they always have, let's call it, money up their sleeve for a rainy day to be able to pay for things when they bob up in retirement.
Jamie, thanks so much for being here today and sharing your financial planning perspective for our property investors.
Thanks, Donna. Property is such an important part of everyone's wealth, and being able to share with you today my view on that has been great.